Hi everyone! In the last 6 weeks, we have experienced an incredibly dynamic period in the market, filled with extreme volatility, with significant market moves caused by the recession fears and policy shifts. This has caused asset prices deviating from their intrinsic values. Here, we are going to break down what happened in the market and where we are now. Since President Trump's announcement of the new tariffs on Liberation Day, we have seen market volatility in levels that only seen in greatest market downturns, such as the Great Financial Crisis or the pandemic. The S&P 500 dropped more than 15% since the all-time highs in mid-February, driven by panic selling and by uncertainty. But just as quickly as market fell, we also saw some of the best trading days in history, with a sharp recovery only in a few weeks. We also saw credit spreads widening and then contracting, which is reflecting the uncertainty and the fear present in the markets. And additionally, we saw the 30-year Treasury yield surging above 5%, caused in the last days by the downgrade from Moody's of the US debt, which is result of the pressure that the US economy is currently having. As the situation unfolded, we saw some shifts in the political landscape. President Trump backed down in some policies, and the US administration adopted a more pragmatic approach. This included renewed openness to business and trade, signaling that the initial hard line adopted by the US administration would evolve into a more constructive and balanced approach. These new shifts was sending an optimistic signal to the market that was discounting the worst-case scenario in April and that might not materialize as feared. Fast forward 6 weeks, and the markets have fully recovered the losses during the panic. Asset valuations that were deviated from their intrinsic values only 1 month ago have recovered and even moved into positive territories. And this is reflecting the more optimistic view of the investors. The worst case scenarios that looked so real only 1 month ago have been dissipated, and the tail risk that loomed in the beginning of April are now faded, and this is reflecting the regained confidence of the investors and providing a more stable market environment. So, what does all this mean for us as investors? Our recommendation remains the same. Stay invested, stay calm, and maintain the focus in the long term. It is crucial to be selective, especially in times of volatility, sticking to high-quality assets and maintaining a portfolio well diversified. We've always advocated for a disciplined approach, trusting in the strength of our asset allocation and the quality of our asset selection. Remain invested and keep focusing the mid to long-term view is the best way to navigate these market cycles. In just 6 weeks, we have seen a dramatic shift from panic to recovery, with markets bouncing back from sharp declines and investor sentiment improving significantly. It is important to remember that the economy and the markets go through cycles, and it is key to stay calm, to be very selective with the asset selection, and to stick to your investment strategy. We have confidence in our investment processes, and we are optimistic about the opportunities ahead. But volatility is far from over, so keep your seatbelt fastened.